Intel Corporation, ticker symbol INTC, designs, develops, manufactures, markets and sells computing and related products worldwide. Headquartered in Santa Clara, California, it is one of the world's largest semiconductor chip manufacturers by revenue. For the last 5 years, the stock price has been very rocky and mainly on a downward trend, hitting lows in the last year of $24.59. It hadn't been this low since 2014. If we zoom out, we can see where it dropped off a cliff in 2021. It's had a 52-week high of $40.64. The dividend history. The yield is currently 1.45%. Looking at historical data, dividends have been paid quarterly since December 1992. The dividend increases were frequent and big enough percentage jumps to keep investors happy, all the way up to January this year, until of course the announcement of the dividend cut. Going from 36.5 cents to 12.5 cents, a massive 65% drop. They've just announced an increase of 13 cents, which is a 1.7% yield. Nothing to get excited about, but at least it's heading in the right direction. The total return CAGR for Intel is minus 3.65% over the last 12 months. 3 years is minus 13.33%, and the 5-year CAGR is minus 5.30%. Total return includes any dividends being reinvested. Compared to competitors, Intel has performed the worst. Nvidia's growth has been incredible. They really are leading the way. Congratulations to anyone who managed to buy Nvidia at the beginning of the year. Let's have a quick look at how it's performed against the S&P. Over the last 10 years, not as bad as I was expecting. If you'd invested $10,000, you would have a 103.3% total return. More than double if you'd invested in the S&P though. It's worse over 20 years. The S&P would have nearly given you 4 times as much as Intel. Intel only giving a return of 144.72%. Something to think about when choosing your investments. If we have a look at the financials. The market cap is $143.9 billion. Payout ratio is 211.18%, which is eye-wateringly high. You can see why they cut the dividend, but surprised they've announced a recent increase, although a very small one. I think to keep investors on side. Revenue dropped in the last year as sales dropped in people buying PCs and server chips. If we switch quarterly, we can see the continued drop in revenue and compare it to previous year on year. All the other charts reflect the continued drop in revenue, only EBITDA is slightly up in the last quarter, with debt also is significantly increasing. Looking at the short-term and long-term liabilities, Intel's short-term assets exceed its short-term liabilities. Long-term, not so much at all. What should be noted is Intel are in a transition, restructuring and in reinvesting for long-term future growth, investing over $20 billion in building 2 new factories in Ohio. The investment will help boost production to meet the surge in demand for advanced semiconductors, as well as investing in home territory. They announced last year that they would have an initial investment of over 33 billion euros on R&D and manufacturing in Europe. The German government and Intel signed a deal in June that would see over 30 billion euros invested in chip plants in return for 10 billion for government subsidies. The deal actually marked an upgrade from previous agreements. Intel only had 17 billion earmarked for investments, which would have seen a 6.38 billion in subsidies. However, Intel later stated that the subsidies were too low due to rises in energy prices and inflation. They have also recently announced a new investment in Poland worth 4.6 billion to ramp up its capacity in Europe for chip assembly and testing, so they're really trying to position themselves to be a continual powerhouse. Another positive is insider trading volume. We can see significant shares have been bought. Also, the big institutional investments have been buying a significant amount of shares as well, which instills confidence for future growth. Q2 is going to happen on July 27th. Wall Street's expectations are low as the company continues to transition, but they expect a modest beat. Q1 earnings earlier this year were not pretty, a nice sea of red, everything down. Despite this, they still beat Wall Street expectations, which helped propel the stock price into the $30 range. Now, what do the analysts think the 12-month price target will be? CNN Business have a 12-month price target of $32, 5.5% downside from where we are today based on 35 analysts. TipRanks have a price target of $32.26, 4.87% downside based on 27 analysts. And Zacks have an average buy price of $31.77, which is 7.81% downside based on 28 analysts. a unanimous expectation of downside. An average price target between CNN, Business, TipRanks and Zacks is $32.04. If we head over to value investing, I've had a look at the intrinsic value based on the discounted cash flow. It has a fair price of $31.52. That's 8.5% downside. And the dividend discount cash flow model shows actually a 4.8% upside with a fair price of $36.13. If we take the average analyst expectations and both value investing models, that would give us a fair price of $33.23. With a margin of safety, that would give us $26.58. This is still higher than its 52-week low. Given the time needed for these factories to be completed and the limited forecasting price growth, I do think there are better opportunities. I have a small holding and I'm not looking to add anytime soon. This is a long play stock and it will take a few years before you can reap the rewards. They have strong competition as well, which also needs to be factored in. As usual, thanks for watching. If you've enjoyed the video, please like and subscribe.